What is going on, guys? In this video, we're going to be continuing our last lesson and talk a little bit more about the characteristics on types of patterns. As you can see, each pattern looks fairly the same, but there is a little bit different characteristics to each one. For instance, the bullish flag pattern has a deeper correction than the bullish pennant pattern. Although they look the same and they have the same characteristics in the sense of it's a continuation pattern before a bullish move, you could see, for instance here, the bullish flag goes down a lot more than the pennant actually does. Vice versa for the bearish flag as well. Here's another cheat sheet on continuation patterns. These are shapes that we will see on the chart. Pennant patterns occur after a significant price movement in a currency pair. This movement is then followed by a period of consolidation, where the pair trades within a range before breaking out in the same direction of the initial move. So the green line starts the move, whereas the pattern pauses the move, but then we continue in that movement direction. If the initial movement was upwards, prices are likely to continue increasing after the breakout. If the initial move was downwards, price is more likely to continue decreasing after it breaks out of the pennant pattern. There's a lot of different trading styles. There's traders who will trade breakouts. These patterns and examples are good for breakout style trading or just overall analysis and knowing where the direction of the market could be going. Here's an example of a flag pattern. Flag occurs when a currency pair's price sharply moves up or down, creating what we call the flag pull. It then trades between support and resistance level, forming the flag's body. You can see here our bullish flag cheat sheet, and then you can see here what we have drawn on the chart. So understanding some other technical tools as well to draw these out, like trend lines. As you can see, we have trend lines drawing out these patterns. Being able to draw trend lines effectively will help you recognize and draw out these patterns and see them more. Flag chart pattern, bullish versus bearish. As you can see, we have the flag pull, which starts the initial move, but then we have our correction finding support and resistance. That's what the flag does. Notice how the flag finds support and resistance kind of back and forth, up and down, kind of in this rectangular range before we get that continuation up. Vice versa in the downtrend. So we have the flag pull, and then we have that range that goes up and down, forming support and resistance before the breakout direction. A triangle pattern is a consolidation pattern that appears in the middle of a market trend, offering insights into future price movements. It involves the currency pair's price narrowing in the short term, followed by a continuation of the initial trend. Rectangles, which is very similar to what we just looked at and some of the patterns we've already looked at. A rectangle pattern occurs when price is constantly trading between a support and resistance level of a currency pair. This pattern suggests a lack of trend at the moment. However, once a breakout happens, price begins to trade in that trending direction, in the direction of the breakout or the initial move. If a rectangle forms after an uptrend, prices break above the resistance level and start increasing. Vice versa, if the rectangle forms after a downtrend, prices break below the support and start decreasing. So the rectangle can form support and resistance. Depending on which direction you're in, you're going to break out that support or resistance. If you're in a bearish rectangle, you're forming support and resistance, and you're breaking under that support. If you're in a bullish rectangle, you're forming support and resistance, but you're breaking above that resistance. A rectangle pattern, bearish versus bullish. A lot of times we can see a retest on the broken level of our rectangle pattern. A lot of times the market will offer a breakout and retest that broken out level that it traded through. Wedges. Wedges are a chart pattern formed by converging price lines that move almost parallel to each other before a breakout. These lines connect the currency pair's highs and lows at price points. If a wedge forms after a downtrend, the price breaks below the support to continue decreasing. If a wedge forms after an uptrend, the price breaks above the resistance level to continue increasing. These are the characteristics and cheat sheets to our rectangle patterns, triangle patterns, symmetrical patterns, and our flag patterns. Check them out to learn more, study these guys, and we'll see you guys in the next video.